Hello and welcome to the John Author's Note from New York. Today we're going to talk about the fiscal cliff. It's been a topic that was rumbling in the background for much of this year, but has now assumed center stage for investors and markets globally since the election earlier this month. Joining me today is David Ader from CRT Capital. Good to have you with us, David.
Thank you.
And let's take a look at this chart, which is quite alarming if indeed we do go over the fiscal cliff, and shows quite a dramatic drop in activity for the economy next year. How likely do you think it is that we go over the fiscal cliff, and what would it mean for markets if we did?
I would say the chances of going over are 100%. I mean, there's no doubt we're going to go over. The question is the cliff as dramatic as one sharp drop, or is it a series of little stumbles with plateaus along the way? And you know, when you look at the fiscal cliff, there are probably a dozen components to it. And obviously the biggest one are the Bush tax cuts, et cetera, et cetera. But if you do the simple math, things that are going to come back into play, I don't see how you can get away with not extracting 1 to 1.5% easily. Mm-hmm. So we're going to go over. The question is it 1% or is it the full 5%? And, you know, recession, not in the U.S. That's going to, I think, depend on what's going on in other countries. Canada's beginning to slow. Of course, Asia's slowing, Europe's slowing. So I think we're going to have to continue to look over there. But I do think it's going to take us down to 1% handles.
So what does that mean for say, the 10-year Treasury? If you look at this chart, which shows the performance of the 10-year yield so far this year, we're above the low in yield of 140 we saw back in July. Mm-hmm. Can we get back down to that level, do you think?
Sure, sure. One of the things about when you look at the bond market now, people are very, very neutral. Positions are very, very neutral. But we have overexposure, if I can use that expression, to some risk assets. So corporate bonds, right? They're rich, you know, and a simple allocation, even if people are more neutral on rates, could give a boost to treasuries to take it down to that level with ease.
So we could see people selling out of the corporate bond market, which has done spectacularly well this year,
mm-hmm.
and come back into treasuries.
Just to reallocate to a more neutral stance. Maybe corporate bonds are rich, and I don't think you're going to get you can't get the same type of performance, yes. I don't think. Likewise, you know, if we look at the mortgage market, very, very rich. And if the Fed's QE goes, well, we've been buying a lot of mortgages, we've dominated that market, we are getting some refinance activity, so it's helping out. Well, let's buy some treasuries instead. So there's some risk there. I don't think it's going to be dramatic, but that would be the motivation to take yields down to, say, 140, 138, right. Whatever the low was in 10s. Mm-hmm. I don't necessarily think we're going to go much deeper than that unless we really have a slowdown to, say, you know, to real stall speed 0% or even negative, which is possible. I wouldn't rule it out, but I don't think that we're going to go below there. And again, to the upside in yields, well, you know, people again don't need to sell treasuries because you don't see a lot of positioning. And if we go through the fiscal cliff, and I think this is an important consideration, you know, the budget is going to look better, the dollar is going to look better, and I think that's going to be positive for the back end of the curve.
Now, of course, wrapped up within the fiscal cliff negotiations is what is Washington going to do about the longer-term debt forecast, which look quite dire for the US as the baby boomer generation moves into retirement. In this accompanying chart, we see that towards the end of this decade, you start to see the budget deficit accelerate. Mm-hmm, mm-hmm. At what point do the bond vigilantes look at this looming deficit problem in the future and say, we have to do something, something's going to happen here?
I think the bond vigilantes have been on this for the past few years, and one of the reasons that you haven't seen, I think, you know, these positions get very long treasuries. It's just not happened in these last 3 years. It's quite remarkable. Even with this rally, you don't see people very long in treasuries. And I think it's been a frustrating point because it's expected, right? Well, you know, the Fed's easing, it's quantitative easing, the whole world is devaluing, therefore ultimately it's going to give us inflation. Well, it hasn't yet, or at least hasn't given us inflation in a big way yet. So it's an issue, it's a worry, we'll keep an eye on it, but as you talk about these, you know, from the bond market perspective, you know, 3 weeks is a long term, but now right. We're talking, you know, nearly a decade, other things could change. We can deal with economic trends, and we can look at the budget, and we know all these sorts of things, but the decisions to be made, whether they're good decisions or bad decisions, mistakes or the right thing to do, are human. And we can't really, you know, forecast, we can't model for what Congress might do. We can't model for the next election. Right. And so it's out there. We're going to keep on harping on it, but I don't think you can trade for that.
Right. Well, on that note, David, thanks so much for joining us today.
Pleasure to be here.
Thank you.